I am so excited to share one of my favorite financial planning topics and investment vehicles, the Health Savings Account, HSA. HSAs are designed to help people covered by a high deductible health plan, HDHP, save and pay for current and future qualified healthcare expenses for themselves, their spouse, and eligible dependents on a tax advantage basis. One of the less known details about high deductible health plans is that they have both minimum and maximum limits for deductibles and a maximum limit for those out of pocket maximums. So having a high deductible alone does not necessarily mean you're covered by an eligible high deductible health plan. Below the video, I've included a link to IRS Publication 969 for more details about these limits and other tax-favored health plans. Although high deductible health plans provide the opportunity to contribute to HSAs, the high deductible often discourages people from going to the doctor unless it's an absolute emergency. So please don't let your insurance deductibles discourage you from going to the doctor when you think you need treatment. Preventative benefits such as routine checkups, exams, immunizations, and screening services are often available within these plans, sometimes without a deductible or with only a small copay. Also, when you previously reviewed your credit card statements during that lesson, did the categories of physical and mental health show up? Examples may include therapy, massages, gym memberships, acupuncture, chiropractic, prescriptions, and other medical appointments. Once again, your physical, mental, spiritual, relational, and financial wellness are all interrelated. Moving on, as mentioned during the pay statement lesson, HSA contributions are either excluded from W-2 earnings, as seen here in box 12, code W, or deducted as adjustments to income on the tax return. No double dipping. Some states may also offer state income deductions for HSA contributions, but they may treat HSA earnings and withdrawals differently. I've included a link below this video to information about each state's guidelines. HSA contributions made through payroll as part of a Section 125 cafeteria plan are excluded from both income tax and employment taxes, Social Security and Medicare. Thus, it's better to maximize contributions through payroll if possible. Otherwise, contributions can be made to the HSA from a bank or taxable brokerage account until the following April's tax filing deadline, similar to IRA contributions. And remember that both employee and employer contributions are included in the annual limits. There is self-only health coverage for individuals and family coverage for the individual and at least one other person. So if you and your spouse, or you and a child, are covered by the plan, it's considered family coverage. I've included the current HSA contribution limits below, including $1,000 catch-up contributions for each covered taxpayer age 55 and up, made into separate accounts. For example, on this statement, Susan contributed $8,200 to her family HSA, which was below the limit in 2023. And since Susan's husband Steve is also covered by the plan and over age 55, he'll need to contribute his $1,000 catch-up into his own HSA by the April tax filing deadline. I am a big fan of the Fidelity HSA since there are no cash minimums or admin fees, and it can sit alongside your other investment accounts. One of the tricky things about HSA contributions is that they can only be made for the months you're covered by a high deductible health plan. For example, if someone enrolls in any part of Medicare during the year, they need to be careful not to over-contribute to their HSA. HSA earnings grow tax-deferred, like other retirement accounts, and future distributions may be withdrawn completely tax-free if used to pay for or reimburse qualified medical expenses. But if they're not used for qualified medical expenses, the withdrawal is subject to income tax plus a 20% additional tax if the owner is under age 65. It is important to notice the emphasis. Unlike a flexible spending account, a health savings account may carry over its balance from year to year, including the investment of some or all of its balance for long-term tax-free growth. Most employer-sponsored HSAs require a cash minimum before investing is allowed. When it comes to distributions, IRS Publication 502 covers the various qualified medical expenses. Beyond common medical expenses, these also include amounts paid for qualified long-term care services, limited amounts paid for long-term care insurance contracts, and Medicare premiums. Given the powerful long-term tax-free growth potential of HSAs, I often encourage families to pay for medical expenses from their current cash flow and other savings, so the HSA balance may continue growing. with current medical expenses available for future tax-free reimbursement. Those medical expense receipts can be saved to cloud storage if they're ever needed in the case of an audit. Our family only saves receipts above $100 to reduce unnecessary complexity. Consider your own ability to pay for medical expenses out of pocket rather than using your HSA's debit card, with part of your emergency fund earmarked to cover your health plan's annual out-of-pocket maximum. To end this lesson, returning to Susan's example statement, we see that Susan is taking advantage of her HSA's long-term tax-free growth potential, investing in a stock fund. And the cash position is primarily her year-to-date contribution, likely to be reinvested with the rest if they have an adequate emergency fund and stable cash flow to pay for current medical expenses. And lastly, here is a visual of their current asset allocation. Again, they'll likely move that cash into the equity position and ensure that future mutual fund distributions are automatically reinvested to avoid cash from building up moving forward. This is a timely reminder to check all your investment accounts for auto reinvestment, making sure that any interest, dividend, and capital gain distributions aren't accidentally building up as cash on the sidelines.